Thank you very much for coming on behalf of ACC, PwC, and Budapest Institute of Banking. I would like to welcome you on this conference, Future of Money Conference. We are very glad that you are here and so many people here offline, and so many people are here actually online, and some of the people arrived in the newly renovated Central Bank building. Some of them, there was a confusion because there are two renovated buildings, but some people will join later on from the other building. And actually this building was the Money Museum as well. And my name is Gergely Fábián. I'm the executive director, I'm one of the executive directors of the Central Bank and the executive director of the Budapest Institute of Banking. And I was also responsible for the Money Museum, and I would like to just start with this short opening that it has a meaning that this building was the Money Museum, and the Money Museum itself to this conference. If you go through the Money Museum, what you see is the functions of the money and the history, the evolution of the money. And if you go through the evolution, it's worth going to the history. What you see in many cases when we had commodity money, when we had precious metal money, when we had the commercial bills award, and then later on banknotes and the fiat money. So what you see actually, the economy, the money, the evolution of money adapted to the economic circumstances, to the economic development. And what you actually see is it wasn't just an adoption, but also this created new innovation. This created a wealth growth, so there was a positive spiral here, much more than just an adoption for the economic circumstances. And if we go there, so it hasn't just followed suit. So if you go there for today, you see how the world is getting more and more digital. So it's obvious that and we see already that the money is following that. And one interesting case will be, which is conference will cover, is the central bank digital currency. So money again adapts to the reality of the new economy, which is a digital economy with more and more digital assets. You already see evolution of digital assets and digital money, but the large question here, which will be covered by Ms. Anikó Szombati, the Chief Digital Officer of the Central Bank of Hungary, is how central banks reacting. And again, here there is a huge, a tremendous amount of opportunities that can be created by digital money, especially in central bank digital currency. A few years ago, I was editing a book which is about the history of banking, but we also covered the future of money, possible future. At that time, it was more like a theoretical thing, the central bank digital currency. It was one chapter at the end of the book, but now it's becoming more and more close to that. So it's a very exciting time for that. And what we see, if you look at the money, is actually what money wants is to have seamless, fast, cheap, and safe transactions and safe flow. And you can see here that is a major reason why we see the digitalization, because that creates the speed, that creates the seamless and cheap transactions, not just within the land, but also cross-border as well. And just to highlight one thing, it's not just about the money flow, but one important highlight is that next to money, what we see transactions, and what transactions are basically informations. So it's not just about that, who controls the monetary system or how the monetary system evolves, but behind that monetary system there are a large amount of data, information, which can again create value and actually multiply the positive economic impacts of the money development. So why we are here, the Budapest Institute of Banking, it shares the values of PwC and ACC. We're here for upskilling, because whatever is happening, starting with from blockchain to crypto assets and its impact on the economy, and even central bank digital currency, people need education, experts need education, experts need upskilling, and on this level we are having workshop conferences, but also education, trainings, and more. This is an important topic for us, and we have, and you will see in the second presentation from Huy Engel from the Center for Finance, Technology and Entrepreneurship, who joined in by his colleagues from London. We created, for instance, a joint training, online training, it's payments in digital finance, which is a global training, so it's over 30 global experts, and actually shows that how important is the topic for us, because what we see actually, if money is a fuel, then payments are the engine and engine systems, and we really cover deeply this topic, and it's a very exciting topic. All the innovations, most of the innovations happening in the payments industry. We see many successful stories there. Basically from nothing, huge companies are evolving, and exactly the thing is, again, if you look at, it's not just about the money transactions, it's about the data. So how they have payment companies, how companies dealing with money can be transformed into platforms, and these platforms with all the data, how they can create value and making them the most valuable financial firms in the world. So, and some of the final thoughts here is not just about the education of the experts, but it's also about financial and digital literacy. So that's why we created the Money Museum, and you will be welcome to take a look around. Now it's closed, but it's really open for you, just for this conference, a special occasion, and I will be the personal guide, and that's a rare occasion. So if somebody haven't registered, please follow, because I was the one who coordinated this thing, both from professional side and from constructional side, and I've seen any details of the development. So welcome here, and you will see. And please be inspired by how the money evolved in the time, because that can be an add-on for this conference, and it can, for this inspiration, you can get more and more ideas and knowledge. Thank you very much, and I will now give the floor to Ms. Anikó Szombati. The Central Bank of Hungary is really a pioneer, or at least a very innovative central bank in terms of digitalization, and it's became then, since Anikó took the role of the Chief Digitalization Officer. So please welcome Anikó Szombati. Join you, welcome. Thank you.
Hello, good morning, everyone, and I would like to warmly welcome all of you who are present here, and we can enjoy the beautiful building of the Central Bank. So, thank you, Gergely, for the kind words, and indeed, I want to start with saying that the digitalization area at the Central Bank is the executive directorate where technology meets finance. So we claim for ourselves that we became experts more or less in both fields, and but it is better if not only one area, but the whole central bank is engaged in both providing the necessary stability, in price stability, financial stability, and provide the safe infrastructure on the one hand, but central banks cannot stop here, because we really need to understand the new technology, we need to understand what the new products are, even though they are not regulated. And of course, in the end, we hope that they will be covered by modern and tailor-made financial regulation. But still, in any case, we will have to protect our customers, our citizens, and we have to make them aware of the specific characteristics of these new products. So the central banks have a more role with financial innovation overall. So my presentation today is built around the concept that we see that currently we are at a turning point in terms of how the financial markets are working, how financial services are provided, and we see three distinct directions which cannot be exclusive at all, but still we do believe that any of the three can become really influential in the future, and so I would say the underlying scenario is that we continue the current status with the prime role of the incumbents, the commercial banks, and insurance companies, and these companies undergoing real digital transformation can or will be able to serve customer needs, to provide instant, very cheap, and very professional financial services. But what if they fail? Who are the challengers nowadays? Actually, the challengers come really from the surface in decentralized finance, where all these services are already available without regulation, without any central counterparty. You can borrow, you can lend, you can invest any time. You can have insurance as well, but still without any regulation, without any lender of last resort, without any problem resolution mechanism. And we cannot neglect the third outcome, that central bank digital currencies are also rising. So more than 90% of the central banks worldwide are already researching this instrument, and we see that this has a huge potential. Up till now, all publications are about to partner with commercial banks in this new endeavor, and central banks and commercial banks, incumbents, and new payment service providers together must serve the need of the digital era and provide digital money for citizens. So, as I said, nearly all central banks are already engaged in this topic, but only a few are in a more advanced status. So these initiatives are more or less payment-oriented without any additional purposes, but still it's a huge step forward, because in this market the central banks have to really compete with current service providers and convince the citizens that their product is better, more user-friendly, and per definition cheaper. But what can be those motivating factors that drive central banks in this road? First and foremost, as Gergely mentioned, 10 years ago it was just an interesting intellectual concept, but since 2019, when the then Libra white paper was released by Facebook, and the concept arose that around 2.5 billion people can have an alternative payment system, which is above any central control, which can invade any country's internal payment system and affect financial stability, affect the conduct of monetary policy. Then all central banks started to think differently about this topic and started to realize that they also probably will need to come up with a modern digital money which they themselves provide to their citizens, because this is the safest forms of money, as today is the cash, but when things go digital, the cash can lose this role. Unfortunately, there was another catalyst event, the COVID-19, which also proved that new platforms might be needed to provide instant help, financial help to those in need, and we could see two distinct solutions. So in China, the post-COVID economic stimulus was using the already existing private platforms like Alipay, WeChat Pay, and they distributed specific dedicated checks or bonuses which had a fixed maturity and which were targeted to different economic sectors. In contrary, the US, they didn't have the infrastructure. They had to provide actually checks written in paper. Even Mr. Trump wanted to sign each of them, but later on he gave up this idea. All in all, $840 billion were distributed, and according to some estimations, more than 10% of this sum went to illegal or semi-illegal organizations or mafia, as you can say, and so the distribution itself had some sense in the wheels. What other aspects might be relevant is that the current payment markets have several drawbacks in terms of timing, in terms of cost level, in terms of transparency, especially cross-border payments. So this is the field where CBDC can have a use case, and also to create a new platform for further innovation to make payments more automated, and not only payments, but other types of contractual obligations when you are buying a house or buying a car, or when you are using Internet of Things, which badly need a new, probably DLT-based platform. But apart from all these motivations, central banks worldwide can have additional dedicated purposes where the CBDC projects are conceptualized. So first and foremost, financial inclusion, which means that the recent launch of the digital euro or the digital dollar concepts all have the aspects that about 5% of the citizens of these economic areas are without bank account contacts, and these central banks would like to provide a facility where all these people can be involved into the financial system. And of course, this starts with the payment, but when you are having an account, you can also borrow, you can make business, your economic fundamentals can be strengthened. But of course, the cash logistics and the cash management costs can be saved. Of course, the effectiveness of the monetary policy can be increased with specific characteristics. And unfortunately, we are having war times now, and the concept that probably a backup system, apart from that one operating today and operated, for example, by global payment companies, can also serve the needs of the economy, to have one which resists to financial and natural catastrophes or turbulences. So overall, we have been examining all these issues for a while, and last year we issued a study book which is available on our website, both in Hungarian and in English, where we summarize not only conceptual design issues, but financial stability, monetary policy, payment aspects, even IT infrastructure implementation questions I considered. So maybe if you are interested, you can deep dive with the help of this book. But what I would like to talk about here is our specific decision-making ladder or decision-making steps which drives us and hopefully other central banks as well to make all the necessary decisions when implementing a CBDC project. And I would like to refer back to all these motivating factors that I introduced you today, and saying that if you are thinking that there is only one single type of CBDC, then you are wrong, because there can be several dozens different types of CBDCs worldwide, even countrywide. There can be different CBDCs coexisting because, as I said, this is a public intervention to current market situations. So you need to answer an existing market failure, or you have to have a specific policy goal that you want to implement. For example, having a backup system that must drive you through all this decision making. So that have to bear in mind when you are thinking about the specific characteristics of a future CBDC. So if the fundamental role is decided, then you can think about, for example, who should have access to this, because in general everyone thinks about CBDC as a retail payment project, but it's not the only way to consider this issue. So there can be specific goals, for example, the financial inclusion of young students who cannot have an independent bank account by law, but whose financial and digital education can be a specific policy goal where the central bank can issue specific projects, as we did. So that, as I will elaborate on this later on. But of course, since it's a central bank project, you always have to consider the monetary policy nature of the issue, because in any way it will affect the balance sheet of the central bank, and you have to bear in mind all the consequences and potential effects. Not to mention, again, unfortunately, wartime events which affected by us, for example, by a quick foreclosure, one existing and very healthy bank, but because of the ownership structure, it had to be closed down. And so all these kind of effects can influence the CBDC and can influence the central bank balance sheet. So what kind of money would we like to provide? Do we consider providing each and every citizen an account where they can also have an interest accruing instrument? Or do we want to heal the problems of the payments market? And what kind of partnership we would like to have with existing market participants? How can we split the tasks and, of course, the responsibilities? And one of the most pertinent issues, which especially in Europe became the most discussed issue, the question of anonymity or privacy of the CBDC, because everyone would prefer to have a completely private CBDC as cash is today, but unfortunately, because of anti-money laundering considerations and terrorist financing considerations, you never can offer such a CBDC, but still there are technologies that can provide quite a decent level of privacy, I do believe. And last but not least, this is the only point when you have to consider technology, as technology today is so advanced that they can answer so many issues and questions. But still, if you would like, for example, as I said, provide something where smart contracts can build on, you definitely have to do a decision towards DLT-based project. But if you not, you are the central bank, so you probably want to have a central system operated. And what other requirements are? So I already referred to the fact that you are entering an already existing market. So you have to consider that it to be really competitiveness increasing facility. It has to consider the fact that interoperability is necessary, and it has to be, of course, a platform which can modularly expand it if the need arises. And I also refer to the fact that the customers have payment possibilities today. So if you want them to use your facility, it really has to be to the latest standards like 7/24 availability, very fast, very resilient, and of course, first and foremost, very cheap. And the central bank itself has to comply with all the requirements that the current service providers must, and these facilities have to be built in. So what we see as the minimal requirement for ourselves when we are thinking about the CBDC project, I referred already several times that we would like to provide a new platform for further innovation for the market participants. We definitely would like a project that serves digital financial inclusion, so we do not want to leave anybody behind in this digital journey. And as the first central bank with a definite green mandate by law, we are considering sustainability issues when implementing this project as well. But we are not only thinking about and writing about CBDCs, we are actively researching on them in several directions. We are running pilot projects at different levels of preparedness, and in the next couple of minutes I would like to introduce them to you. I think that one of the most prospective ways to enhance financial inclusion and to enhance the openness towards digital money is to approach young people, especially those primary school year students who can already have some money to save, who can already buy some basic things all alone, but who are deprived of having, for example, individual bank accounts or broad financial facilities by law, because they are not independent persons defined by law. So we decided to launch a project which is called Digital Student Safe, based on a former construction. Maybe someone in my age can remember the Takarékbélyeg scheme, which was an analog form of collecting stamps and savings money with the help of the school, and finally at the end of the school year redeeming it in a bigger sum of money and being able to spend it for any toys or bicycles and so. And so we try to simulate this project in the digital age, and we created a system where students can answer quizzes in digitalization, sustainability, and financial areas, and for the proper answers, they could collect specifically designed digital stamps, and at the end of the savings period, these stamps can be redeemed at a certain web shop for real toys. So in economic terms, it's already a CBDC, even though there is not real money in the system yet, but we are working on the possible extensions into this direction. So here you can see some screens where you can determine your savings goals, and where you can answer quizzes. And of course, since it's a children-targeted tool, the parents are also involved, and the parent can provide or transfer digital stamps to the children for free of charge, or with some conditions, like you can embed that you have to walk the dog to earn money from your mom or dad, and so on. And all these conversations can be exercised within the app. We do believe that this is a success. We have more than 3,000 children and more than 900,000 quizzes answered already. But what I would like to introduce as a new project, which will be launched pretty soon, hopefully, is the mobile application of the Money Museum, which on the one hand can guide all the interested children and guests into the museum, but on the other hand it will be a platform for registering collector coins on a private blockchain network of the central bank. And so the newly issued collector coins will have a specific package with a QR code, and then the ownership of the coins can be registered, and if you are trading with them, the trade history can also be followed. And we are also planning a specific commemorative game based on quizzes, where you will be able to earn digital representatives of the Hungarian currency's name, the forint. So the 6 different letters can be earned randomly, and they also have to be traded to collect the whole series. And in the end, you can redeem your digital forint to a physical forint set. So in technology terms, these digital representatives of the forint will be NFTs, because they will have distinct serious numbers. So we do hope that we will be the first central bank worldwide to provide an NFT on a central bank blockchain. And finally, some other directions. We are also working on so-called wholesale CBDCs, which are available not to general citizens, but to professional financial service providers, banks, as safest forms of money and the basis for trading among themselves, especially cross-border. And with the help of the Singapore Monetary Authority, we became the observers of one of the leading projects worldwide called Project Dunbar, which closed its second phase recently, and which aims to build a dedicated DLT platform for all these 5 participant countries, where the central banks are issuing their own CBDCs, but these CBDCs can be traded cross-border, but with full control remains with each and individual central banks. Very exciting project, but as in new technologies always, there are more questions than answers at the end of this phase, so we do hope that we can work together for further solutions. And what we are working on, we also have the Budapest University for Technology Studies as a partner, who are also building us wholesale CBDC platform, where we will be able to invite commercial banking partners in the future, and where this platform can serve us as an experiment how we could automatize current financial services like car leasing, trade finance, and factoring, which involves a lot of conciliation, reconciliation nowadays. So this is what I wanted to share with you today. I'm sure that you have more questions than answers. So if you have any specific issues, please contact me at the Central Bank of Hungary. Thank you very much.
Thank you, Aniko. I think this was a really exciting presentation, and maybe let me introduce myself first. My name is Gábor Balázs. I'm representing PwC on this event. We are one of the co-organizers, and I have one confession to make. I'm actually not an expert in this. I'm just an excited amateur, and why I'm standing here, and I will be one of the presenters as well. When we were discussing with Gergely what sort of cooperation we would do with the Budapest Institute of Banking, we were doing a lot of things together, like accounting, dates, financial services, regulations, all of that. But I think we share the passion of new innovation in finance and cryptocurrencies, and we thought, why not do something about the future of money when we have this wonderful venue who is really covering the past history of money. So that is a very nice connection. Also, I think there are a couple of finance professionals besides myself in this room and definitely online. Why all of this is important for you? I think even if you are not an expert, such as myself, if you really consider there was not really a huge amount of innovation in the world of finance, payments, in the last 20 or something years. Ever since we had the money transfer implemented, we've done some other things, but no fundamental revolution in the way we do finance, the way money is handled, and this is actually the new revolution. Since we are finance professionals, we need to be on top of all of this. We brought a couple of experts to you. I think you've heard the central bank aspects, and definitely central bank digital currencies is probably one of the top 3 buzzwords recently. So, as Aniko said, we have probably the vast majority of the central banks experimenting with this. This is the centralized vision of the future of finance, but there are also decentralized things happening. And I would like to welcome the next presenter to the stage, Huy Nguyen, who is going to be talking about the international aspects, a little bit the market, about the currencies, and finally why finance professionals, such as most of us, should be interested in following the developments. So, welcome on the stage.
Thank you very much.
Hello, hi everyone.
And who thinks that digital assets are just a big bubble and a big hype and nothing will happen out of this? I need to go to the mic.
Okay, sorry, I forgot that for online. Okay, so who thinks that digital assets is a big bubble, big hype, and actually it's useless? Nobody? Okay. Okay, so that's interesting. So I guess for this audience, that's interesting that you're quite open about this idea of digital assets. So first, let me introduce myself. I'm Gui, co-founder of CFT, and CFT is a global corporate university in fintech and digital finance. And we were created with this very simple mission of helping everybody who wants to be part of this new world of digital finance with the right skills. So we work with a lot of amazing organizations around the world. We work, for example, in Singapore. When Singapore, we work with all the banks, for example, for training them on artificial intelligence in finance. We upskilled the financial sector in Hong Kong with 50 banks for them to understand fintech. We trained the government in Abu Dhabi, for example, about digital transformation. But very, very importantly, we had the chance to be partnered in Budapest with VIB and MNB, where Gregory mentioned that actually during COVID, so we didn't meet during COVID, we created this program about digital payments. It became a reference program about digital payments, where we have amazing people on this program, more than 30 experts from Uber to N26 to the Bill and Melinda Gates Foundation, giving their views on what is digital payments. And with the central bank, we also worked on artificial intelligence and the impact for artificial intelligence in finance. And I think that in terms of what is happening in Hungary, it's quite amazing in terms of the whole ecosystem and how it has evolved. Before that, I used to be a banker. So I used to be a banker at Citi, RBS, SocGen. I used to be head of macro structuring, head of insurance structuring. So I think some of you are from the finance world, so I can also relate to that. And actually, I wasn't born as a banker. I started actually as an entrepreneur, CEO of UKB. And UKB was LinkedIn, but 5 years before LinkedIn. So very wrong timing. And I think we'll talk about timing also, because when we talk about all those innovations, timing is really, really important. So I try to give you the view from different parts of the industry, academia, as an investor also, and we'll talk about digital assets. But why digital assets today? And let me first claim my view, because it's a world where a lot of people have a lot of different views, and there's a lot of vested interest also. So let me tell you what is my view, very simply, which is a few years ago, in 2014 actually, I wrote about Bitcoin. And at that time, I said, Bitcoin, really, really interesting, was really changing the way that we're thinking about money, but was still very immature. Was still very, very early, especially from a technological standpoint. And so I said at that time that Bitcoin had the opportunity to be what ARPANET would be for the internet, which was really the beginning. And if you remember, it took 10, 15 years before the beginning of ARPANET until the internet that was really useful for everyone. So that was my view in 2014. 2017, 16, when everybody was talking about blockchain, remember a lot of investments went into blockchain. I said, blockchain, really, really interesting, but at the same time, not there yet in terms of technology, not there yet in terms of being able to be used at scale. So that was my view a few years ago. That was really a transformation in terms of the way we think of money. So really interesting from a conceptual standpoint, not there from an implementation standpoint. So what about today? What about today? So first, let's take a step back. Digital assets, they've been around for a long, long time. We've talked about digital assets for 20 years, 30 years, pretty much since the internet. You know that really well in terms of all those files that we use, PDF, MP3, etc. Even digital money has been around actually for a long time. Perhaps some of you used it 20 years ago. Here we have DigiCash. If you look at the scheme for DigiCash, very, very similar to what we're thinking of digital currencies today. And even the metaverse, Second Life, has been around for 20 years actually, had quite a big economy 10 years ago. So it was already there. So why are we talking about this now, today? First, because some of the things have changed a lot. Cryptocurrencies, very big markets in 2016, 17, 18 started to grow a lot. But if you compare to what happened at that time and today it's 2, 3, 4 times the size. So it's of course the size of market capitalization, but much more importantly in terms of user adoption. There's much, much more people who hold, for example, a wallet that has, for example, crypto or Ether. Actually, let me ask a question again. Who has a wallet? Anybody holds a wallet? Crypto wallet, yes, that's a physical wallet. So so quite a few people actually have a wallet. So you're starting to see much more in terms of adoption. So, we might think of applications, etc., but in terms of reality of adoption, it's starting to be much more. NFTs, a year ago, I think nobody knew what an NFT was. Today, everybody knows. Even our children talk about NFTs. So, NFTs have really taken the world by storm. And of course, it's not just about on the retail side, on the consumer side, it's also about central bank, which Aniko just mentioned, with CBDC and a lot of organizations now trying to adopt CBDC. So my view today, compared to a few years ago, is that the reinvention of money in the digital world now is underway. And it's coming from all those different sides, but it is now well underway. So it's not a question of it's a concept anymore. Now it's a question of it is being implemented now. So all the discussions that we just saw, I think are really, really important because the timing is now. So why? So why? It has been around for 10 years, 20 years. Why now? And I think this understanding of why now is really, really important. So at the core of money today, it's really around trust. It's really around trust, and trust coming from institutions, coming from central banks, coming from commercial banks, and of course the issue of no double spending. It's really important. If I have a friend in my pocket, if I give it to Gabriel, for example, it has to disappear from my pocket. We cannot have two versions. So this is really at the core of money, but which is really almost the opposite of the internet. If I have a picture, for example, on the internet, it's very easy for me to replicate it once, twice, 3 times, 4 times, etc. It costs nothing. This is really at the core of the internet, the idea of being able to replicate things and do them very, very quickly, very cheaply. And so what is really key, of course, is the answer to double spending, which was the distributed ledger that started in 2008 with this white paper from Nakamoto. And after that, with this very, very simple idea of having a ledger, and with that ledger you can see all the transactions, and that's why we do not have this issue of double spending anymore. It took a while actually to reach that level. It took until 2008 to be able to have no trusted third party and solve this issue of money. And so that led to this whole explosion of the 15,000 types of cryptocurrencies that we have, and NFTs, and etc., etc. And the difference, so we talk a lot about DeFi, and we like to compare DeFi to traditional finance. I prefer actually to compare DeFi to InstiFi, because I think really the way we think is decentralized between institutions. When Bitcoin started, that was really, let's call that a rebellion against institutions after the crisis of 2008. It really started like this, which was, there was a shift in trust in 2008. If you remember 2008, that was the beginning of a lot of the first fintech innovations. Peer-to-peer lending, Bitcoin. That was all the idea of, after the financial crisis of 2008, we don't really trust the system anymore, the large central banks, so we want to go outside of this. Peer-to-peer lending, I can lend money to someone without an intermediary in between. Same thing for Bitcoin. So that was a shift in trust in 2008. That was the first part of the innovation that we saw in fintech. From there, what happened? From there, we saw basically this tech revolution, distributed ledgers, that's it. So we saw a tech revolution that allows basically to do these transactions without a trusted third party. From there, over the last few years, we have seen a shift in behavior. So, for example, the number of people who have digital wallets, so many people have a very considerable amount of money in this thing which they don't really understand, which is Bitcoin, Ethereum, whatever it is. And then we have started to move into something which is different, which is a shift in trust, which is a lot of people now trust this system, this technology for their money. They don't really understand it, but in the same way as not a lot of people understand how the internet works. But basically, our businesses are built on the internet, we don't really understand how it works. But now a lot of people have started to trust this system. I think really, really important. Really important because this is now at the inception of a lot of the trends that we have seen, not just in finance, but also across a lot of different sectors. going from centralized to decentralized, from, for example, commercial software to open source, from hotels, for example, to Airbnb. We could take taxis to Uber, for example, intermediary to peer-to-peer. It is a big, big trend that we have seen, not just in finance, and I think that it will continue for quite a while. And so now let's talk about digital assets. And so what are digital assets? Because it can be very confusing. You said there's 15,000 different cryptocurrencies. We can talk about the layers, the technology, the protocols, the usage, NFT, etc. So very, very confusing. So the way I'd like to simplify it is at different levels. The first level, which I think is the most important today, is distributed ledgers. So the technology. At the bottom, distributed ledgers have really allowed for things that we couldn't do before. And here, there's a lot of different ways of talking about it, but let's call that the technology level. From this technology level, we go a bit higher. We create asset classes. What kind of asset classes? The cryptos, CBDCs, NFTs, tokens in general, or even more widely, proof of ownerships. So different types of asset classes. Then on top of it, what can we do? We can do very simple finance. We can exchange them, we can pay with them. That's how Bitcoin started, for example. And then on top of it, what can we do? We can start to do more complex finance, smart contracts, derivatives, decentralized applications, for example. And then on top of that, what can we do? We can start actually creating new financial systems, almost like DeFi, or even use them in gaming and metaverse. And so I think this is one possible representation. I'm sure there are some other ones. We're always very happy to discuss about it. But if we think of the technology now is much more mature than, for example, 3 or 4 years ago. We're still, for example, on the main ones on proof of work, which is not great, which makes no sense for me in terms of killing the planet just to make calculations and validate transactions. Now we're moving to other types of validation, like proof of stake, which is starting to be much more widely used, miners, etc. So technology, really, really important, because now we have reached a level of technology which is, let's call that, good enough to start building on top of it. The asset classes, more and more, started with Bitcoin, cryptocurrencies. We had CBDCs, banks, central banks looking into a similar way of issuing money, NFTs since last year. Now tokenization is starting to be used more and more, proof of ownership, etc. So all those asset classes, and I'm sure we will have more and more. So we're starting to build all those different asset classes, which allows for simple finance. We're already there. So exchanging, transfer, payments, etc. Now we can do it. So we're there. Now we're starting to reach the second level, which is more advanced finance. So derivatives, we have now derivatives on cryptocurrencies, raising money, the equivalent of fundraising that you have in the real world. We have ICOs, for example. We can do lending, smart contracts, etc. And then finally, we're starting to move into something which is quite different, which is a new system. And so DeFi is really at the beginning at the moment, but I think if you had to perhaps on this slide just think of one thing which is really, really different between institutional finance and decentralized finance, is anyone can create financial products. This is really, really important. If, for example, for some reason, I wanted to create an insurance product today, there's no way I can create an insurance product. I am not an insurance company. If now I move into the DeFi world and I want to create an insurance product, I can create an insurance product just by myself. If I'm a good coder, I can do it because I will be able to have the technology stack, I will be able to have the ecosystem, the community, the money, also the funding, for me to create an insurance product. So what we're likely to see coming from the DeFi world is an acceleration of product innovation in finance in this world of DeFi. Quite possibly also, as it, of course, out of 100 innovations, you might have 99 that will fail, but perhaps one that will be really interesting. And what you could see is that this one can not only work really well in the DeFi world, but perhaps also in our traditional world. So we are likely to see an acceleration of products and services created on distributed ledgers, and potentially, perhaps, I don't know yet, a new financial system on the blockchain. I think we're still quite far from this. And so what is the impact? And I think I will finish on this. The first one is really product innovation. If you're not involved in the DeFi space, if you're coming more from traditional finance, you will be amazed by how quickly it is going in the DeFi world, just because of what I mentioned. So the amount of innovation that you see in there, including on things like scams, for example, including on things like frauds. A lot of the frauds that you see today in let's call that Web 2.0, which are very advanced frauds, are actually coming from the world of crypto, for example. So a lot of product innovation for good or for bad. New asset classes, definitely, and new asset classes that can be used, that can be traded, that can be used for asset allocations also. So I call that players, but it's players not in the traditional sense of, it could be fintech startups, of course, they could be just two men or two people in a garage, and perhaps a new financial system for the digital world. So that concludes my presentation. And in terms of conclusion, I would say the main takeaway from this presentation, you remember my story about my timing, which I got totally wrong a while ago. And the question of timing is really, really important. We have been following this space for a long time, since 2014 actually. And what we're seeing now is this huge acceleration because the technology is there, the ecosystem is there, you're starting to have a big critical mass of people working on this. So you're likely to see much, much more happening there. And at some point, it will be converging. So really, really exciting to be part of this world. So thanks a lot for listening. And if you'd like to continue the discussion, don't hesitate either by email or LinkedIn. Thank you very much.
Thank you very much, Julian. Such passion and such energy. When I saw the slides before, I thought we were never going to cover it in the time allocated, and we were spot on time. So congratulations, not just on your energy, but actually keeping the time. A little bit of administrative announcements to make. First, for those of you who are in the room physically, we are going to have a short break, and I think refreshments are served outside. For those of you online, you also can stretch your legs, and I think we will be back at 10:40 Central Eastern European time. If you are in the building, one administrative announcement that we forgot to make: the building is beautiful, but please refrain yourself for taking photos. I think we have some security measures since we are in a central bank building. So enjoy it with your eyes, but not with your cameras. And see you all back at 10:40 Central Eastern European time. Thank you very much. Okay, I guess most of you have managed to make it back from refreshments. I certainly observed a lot of exciting discussions, hopefully about the topics that we've covered in the morning. Welcome back from the break, also people online. So we kick off with the topic that everybody has been waiting for. Obviously, I'm joking. So since we are covering topics that will be interesting for finance people, accounting people, actually you shouldn't escape talking a little bit about accounting. And just trying to cover my 25 minutes so that it gets a little bit more exciting from accounting, I'm actually trying to cover 3 topics. A little bit of accounting. I can promise you, you will not be an expert in accounting for crypto. Risk considerations, so what sort of risks that the companies that are investing into these crypto assets, digital assets, should be considering prior to investing into these assets. So a little bit the company's perspective. And finally, just stepping into the shoes of the auditors, some considerations that we as auditors have faced in trying to audit companies that have invested into crypto assets. So maybe before I get into the wonders of accounting, I wanted to start with a couple of numbers, just to give you a little bit of context about all of this. So first number is 3, and just for your information, this is the total number of crypto accounting projects I was involved in. I'm a regional expert in accounting for cryptocurrencies. So the total number of projects I was involved in the last fiscal year, it is also the number of projects that I'm involved in this month. So just wanted to highlight that actually the wave is increasing. I think pretty much everybody before me said that probably this is the time. You know, technology has been around for some time, but the adoption rate is increasing, even in Central Eastern Europe. So all of these projects that I'm working on in parallel are projects in Central Eastern Europe. So it is not so far that you might imagine from yourself. Again, I will probably share some details about some of the projects I'm working on. Next number is 13. Just getting to the world of accounting. 13 is the number of years it took the IASB, so the IFRS standard setter, to issue a standard on accounting for leases. The project started in 2006, and finally we had a standard that is effective from 2019. So 13 years is pretty much the pace of standard setting that the accounting regulator is doing. Now, 13 is also the number of days that was spent, and I was, to be honest, a little bit cheating with it as well. The number of days from the publication of the white paper, so the original document that promised a lot of good things, from dramatic increase in market value and total market collapse of something called the Squid Coin, or the Squid Game token. This was a currency that was issued. Everybody thought it's the greatest next investment, and then in less than 13 days, actually, it collapsed. And I think the creators have gone away with a couple of $1 million of investors' money. So just to highlight the differences between the pace of standard setting and the pace of change in the crypto world, I think we need to really up our game as finance professionals. The next number is 0. So 0 is the number of IFRS standards, accounting standards dealing with accounting for cryptocurrencies. It also happens to be the number of auditing standards dealing with auditing cryptocurrencies. So we are in uncharted territory here. So that's why I think all of this, what I'm going to say and cover, is pretty much our view, industry practice, not something that the regulator has issued or told you. So just moving on to the agenda, as I mentioned, I will cover these 3 topics. Accounting considerations, very, very briefly. I can talk about this for probably 2 hours, but you wouldn't be very happy. So I will try to limit it. Risks addressed by the companies, and then finally, an insight into auditing. So accounting considerations. I would probably cover 2 slides and then maybe a little bit of exercise. I will give you the answers, so don't need to worry. The first slide is about accounting for holders of crypto assets. This is probably the better researched area. So this is what happens if you are investing into a digital asset, a crypto asset or any other token, and you want to make sure that it's properly reflected in the financial statements. The general view is that most cryptocurrencies, so if you talk about the widely used ones like Bitcoin, Ether, and others, are intangible assets under accounting. So they are not something you can touch, does not meet the definition of money yet, so it cannot be financial instruments, and therefore they are accounted for as intangible asset, pretty much similar to software licenses or any other intangible license. Other types of digital assets can be accounted for differently. Again, even as accountants, you need to understand the underlying nature of the asset to make sure that you account for it properly. So if you have, for example, a utility token provides you access to future services. It's actually not so different from a prepayment. You pay something now and you get some services in the future. So they are generally accounted for as a prepayment. There could be security tokens. They are generally, as the name would suggest, treated as securities, both from a regulatory perspective and also from an accounting perspective. And there could be other tokens which probably would be covered by other standards. Initially, you would probably report these transactions at cost. So the amount of other crypto or fiat currency that you have paid to acquire them. If you are into the business of mining or staking, then you actually generate some of these, then initial recognition would be at fair value. Now, the number one question that I'm getting from clients is, what is the fair value of a newly created cryptocurrency? And I always tell them, my best guess is 0. And I'm actually not a valuation expert, so but that's the million-dollar question, especially for new currencies. Subsequent measurements, so how you account for these cryptos as a holder after acquisition, it actually depends on the nature of the asset and the standard that you acquired. So if it's an intangible asset, it's probably treated as an intangible asset either at the cost model, so record it at the amount you paid, or revalued through equity. So a slightly more difficult area is the other side. So what happens if you are into the business of actually issuing or minting new currencies? It is a tricky area because there is much less guidance for it. Again, I think my advice would be is to start from the so-called white paper. So this is a document that actually describes what the entity issuing the currencies is providing. So what is that you are getting in exchange? If it's a residual interest in the company, it's very similar, even if it's legally not equity. It's very similar in nature in equity, so you probably classify it as equity. I've never had, by the way, a situation like this. If you are providing a utility token or something that will provide future services from the company, then you are in the wonderful world of revenue recognition. You are providing future services in exchange for the tokens that were just issued. So token holders will get free or discounted services in the future, very much the revenue recognition guidance. Again, the revenue recognition guidance is not exactly designed for this, but we try. Some companies also issue an option to redeem some of these tokens for real money or fiat currency. That very much sounds like a liability. Because if you need to pay some real cash or fiat currency, then you are in the financial instruments world. You have a financial asset and a financial liability. And if you read the white paper and there is not much that the company is offering, yeah, it's probably a fraud. So you should stay clear of it. So if you don't understand what you are getting, it's probably accounting is the least of your problems. That would be my answer. Again, valuation I think we've covered, fairly tricky. We have some guidance, we have an in-depth publication for this. So we have some guidance on how to value crypto assets. The more widely traded, the easier the valuation is, obviously. So let's give an example, and this coincides with some of the projects that I'm working on at the moment. So this is about gaming. I think you mentioned that one of the new applications of these digital assets, besides the metaverse, is the gaming industry. So a typical scenario is that this company, let's call it Alpha Gaming, they issue newly minted tokens, let's call them Alpha tokens. They will be issued or put to an exchange, so they will be able to be exchanged to any other cryptocurrency. The use in the game is that you can buy specific virtual items in the game. That will also be represented by NFTs, non-fungible tokens. It's really good that now you know what non-fungible tokens are. So basically the use of this cryptocurrency is either to sell for other cryptocurrency on an exchange, or to buy NFTs or virtual items in the game itself. Since the company is just starting to develop this game, they basically pay their employees, their suppliers with this fantastic new Alpha token that they have just created on the blockchain. So what is the accounting from the issuer's perspective? Without getting into the details, again, we are selling the promise here. So we are selling the promise that if you buy our tokens for real money or other more variable cryptos, you have the opportunity to buy in-game items when the game would be finished and delivered. So it's actually a promise. What accounting standard used for accounting for promise? It's the revenue recognition standard. So basically, any value that they receive on issuing these tokens will be deferred until they provide some service, and the service is most likely issuing the in-game NFTs when the game is finally published. Again, not a very nice accounting because they get some money, they get some valuable cryptos, but they only be able to report the gains and the revenue when they actually make the game operational and issue the NFTs. Accounting by the supplier, again, I was involved in both sides of the story. So maybe you are one of those guys developing the game, and instead of real cash, you are receiving these tokens. So, or maybe a combination of real cash and tokens. Again, you are providing the service to the company by building or doing the software development for this game, and you get a combination, let's say my second example, a combination of real cash, like accepted cash, and virtual items, which we just described, it is not cash, so a non-cash consideration. Again, you would apply the non-cash consideration guidance that we have in the revenue recognition standard in accounting and valuing the tokens that you receive in exchange for your services. So that's in a nutshell. Obviously, in real life, it's a lot more complicated. So moving on to the second topic, and that is what you should consider if you are investing into these assets as a company, and you maybe have a legitimate other activity, and then you are branching out to investing into these crypto assets. So I'm not going to go into any of these in detail. This is just kind of highlighting the aspects that you need to consider if you are sitting in one of those companies. So one of the things that is tricky in the world of crypto is the source of funds. Obviously, there is a lot of press going around on crypto being used in illegitimate activities. I think if you are into this world, you know that this is very much blown out of proportion. So yes, it is used for illegal activities, but it's really not the majority of the transactions. Nevertheless, if you are investing into those assets, you would need to make sure that they are sourced from legitimate activities, or they were not part of a money laundering scheme, for example. Needless to say, cybersecurity is one of the top concerns. I think you probably have read a lot of news about hacks. They are generally not hacking the blockchain itself, but usually the weak point, which is usually the crypto exchange or any other party holding the assets. So cybersecurity considerations are very important, and you need to choose your providers very carefully. That's why I'm here. So obviously accounting and tax considerations are very important. A lot of tax authorities are really struggling to provide meaningful guidance on the taxation of crypto assets. I think Hungary is, again, relatively ahead of the field in this respect. But you need to consider the tax implications and obviously the accounting implications as well. Investment risk, I think we probably covered that. One nice thing about the decentralized products is that there is no investment guarantee behind it. But it's not a nice thing actually, that a normal investment is generally guaranteed by someone. Here you don't have a central guarantee on those investments. I guess I don't have to explain to you the price volatility. The price volatility of these crypto assets is much higher, especially if they are not one of those established ones, than any other investment, pretty much. Regulatory uncertainties. So we have, I think, a weekly update in PwC on the regulatory changes in various countries relating to crypto. And the fact that we have a lot to tell is because there is a lot happening in the regulatory world. So some countries like the US have gone, I think, quite far in regulating some of these crypto transactions. Some is still like not regulated. So it's really the wide west out there in terms of regulation in some of those countries. Reputational risk. So imagine if you are a reputable company, you are the treasurer of that reputable company, and you just invested in this fantastic new cryptocurrency called the Squid Game token. Yeah, and then you blew the money in less than 13 days. So the reputational risk is something that you definitely need to address. And I will talk about internal PwC reputational issues a little bit later. Finally, processes and controls. Again, we are accountants, so you need to have some processes and controls around investments. These would be different to any other investment that you had in the future. So the whole control environment would need to be changed in order to accommodate investment into these assets. So moving on to auditor, everyone's favorite topic. If you are an auditor, you are bound to be interested. If you are not an auditor, then somebody will probably audit you at some stage, so you would also be bound to be interested. And let me tell you what was the official worldwide PwC position about auditing entities that are into the crypto space up around 2 years ago. Yeah, so that is the executive summary of the PwC official position. Obviously, as you have seen, the world has moved on since, so we couldn't afford to stuck our heads in the sand anymore and kind of refuse auditing any company that is investing into crypto. So this is in the past. I think our global policy have changed about 2 years ago. And what is our global policy? And what is the best practice of auditing crypto? Again, we don't have a lot of time, so I will try to explain it fairly shortly. So there are basically 3 aspects that you need to consider. One is client acceptance. So as you know, auditors are a picky bunch of people, so we don't just audit anyone from the street, but we have something called the acceptance procedures. So we accept only audit of companies that are of high standing and probably would not be detrimental to our brand. This is extremely important for companies involved in the crypto industry because of all the bad press that you have read and we've also covered recently. So these are some of the things that you need to consider here. Materiality of the transaction. So maybe this is just a side business, otherwise this is like a very traditional business. Nature of exposure. What sort of cryptos they are investing? Are they issuers or they are holders of these cryptos? I've talked a little bit about the internal controls. They have some internal controls in place for that. What is the regulatory environment in the country that the entity is incorporated? Do we have clear legislation and regulations around it? So maybe this is one of those wild west countries I was talking about. Other activities I mentioned, and I think these strange 3-letter abbreviations that you can see is know your customer, KYC, and anti-money laundering. Clearly, because of all the things I just mentioned, this is very important here, to know what is the source of the funds, are they involved in illegitimate activities, and so on. So this is about acceptance before you can actually accept the audit, and then it's about planning the audit and obviously doing the audit. So in terms of the planning, you need to be sure that you know the source of the audits, whether they actually keep those cryptocurrencies on a centralized exchange or maybe in private wallets. Then it's probably a no-go for us. What sort of places they keep their investments, how do they value them, do we have any issues on the valuation? Again, I think I had only 5 minutes on accounting, but it's very complex. So what sort of accounting policies they've applied, risk of fraud. So are we sure we understand why they are into this business and so on. So we are, again, trying to make sure that everything is all right. In terms of executing, the first important thing is involvement of experts. Again, I think I had that confession at the introduction that I don't consider myself as an expert. More like an amateur in this, so it is really important that we involve the real experts who understand the technology behind the risk behind the things. control environment. I think the one specific thing on crypto is if you have private wallets, what are the controls over the private keys? I think we will see on the next slide that some of the auditors have not had a lot of considerations around that. To access your wallet, you need to have a public key and a private key. The private key is really your password that actually proves your ownership of the investment. But is it really your private key or somebody else's private key that just landed it to you for the purpose of the audit? Valuation again, and obviously disclosures in the financial statements about why we are doing it, the extent, and all sorts of other things that are important for the investors. So, what do the regulators say? And that is a very interesting one. The Canadian accounting regulator did a review of auditors in Canada that were auditing companies having significant crypto investments. And I think they selected like 7 companies and 6 failed effectively. And I think the fundamental reason for failing the audit of the auditor regulator is that they don't understand the business. So they were trying to apply policies and procedures that were designed for the crypto area for things that are essentially not like things in the crypto area. So what were the considerations here? Auditors did not have an adequate understanding of audit risk when they designed the audit procedures. So clearly, they missed these steps in the planning that I was just talking about, to see the exposure, to prepare, appropriately design the procedures to cover the new things that they need to cover. The auditors relied on information from crypto exchanges without actually evaluating the reliability of this information. One thing that is important, that if you hold some cash or listed securities in an exchange, generally that exchange is regulated. So you can trust that there is regulation behind, there are controls behind, that whatever securities that you have from that exchange are really there. Some of the exchanges may not be regulated, may not have the same robust internal control procedures as regulators or stock exchanges in the real world. So you need to just question the reliability of information. If you just had confirmation that we are holding these crypto assets on behalf of the company, you need to see who issued that confirmation, whether it's a reliable exchange, whether they are under regulation, and so on. They clearly have missed that. Number 3 is pretty much about the private keys. So if you are not using an exchange but using own wallets, I think a lot of the audit firms, they just said that somebody sits down, shows the access to the cryptocurrency in the wallet. Again, it is difficult to determine whether the private keys are held by the individual or the private keys are held by the company. So even if you see the existence of the crypto assets by someone, is it really the company's assets or just somebody using those private keys to show you what they want to show? Auditors did not evaluate the reliability of information obtained from blockchains. I think we talked about how safe the blockchain infrastructure is, and that is true for larger, more actively traded currencies. But there are obviously ones that are newly issued. The volatility is much less because it's new. So for that, actually, the technology might be also subject to issues of being cracked, to put it that way. Number 5 was also important or interesting. So there were a couple of companies involved in mining of crypto, generally Bitcoin and other things that operate with the proof of work concept that we have also learned in the previous months. So the auditors failed to see that the amount of cryptocurrency that these companies had is reasonable based on, for example, the energy consumption, the computing power that these companies have. Again, there is a risk of money laundering effectively by creating these mining companies that actually do not mine a lot of cryptocurrencies. They just pretend that they obtained some of it from mining. So they did not compare whatever is reasonable and realistic based on the technological capabilities, the energy consumption of the company with the actual crypto generated. So this is 2019. Hopefully the auditing got a little bit more reliable since then. So summary, crypto is so much more than just Bitcoin that you have heard. It's definitely coming. I think we haven't really had the time to get the presentations together, but everybody is telling you that this is the time. The technology was there. The adoption rate, remember the number 3, the adoption rate is growing even in our region. Accounting can be complex, seek help, yes, so that there is a reason why I'm getting so busy with all these things, because these are complex and the accounting standards are really not designed to handle these things. Risk should be assessed before investing, so all those considerations that I've highlighted, I think some things that you need to consider. Doesn't mean that you don't need to invest, but those risks should be addressed. And obviously, auditors, or if you are on the other side of the audit, should be careful in auditing these. So final message is, don't be an ostrich, change is coming. So even if you haven't dealt with these before, I guarantee that you will be dealing with these very, very soon. So thank you very much. I hope you had a nice introduction to the wonderful world of accounting and auditing of cryptocurrencies. Now, I said before that I just pretend to be the expert here, but actually I do have a real expert coming right after me, also from PwC. He is the blockchain expert of the PwC network from PwC London. He's also the author of one of the best books in blockchain for business. So check it out. And I welcome on the stage Aidan Jones.
Thank you. What a truly excellent set of slides. He said I was an expert. Well, I can assure you, I'm one of the luckiest men in the world in that every day is a school day. I'm fortunate enough to come to PwC every day and learn, and it was a huge pleasure to hear what you had to say, because I learned something from that. Second thing is, what a glorious building, what a glorious day. I've been coming to Budapest now for almost 20 years. So I first came about 2002 with Accenture, actually. So we were looking to